Bitcoin just lost its footing again. Last week saw a brutal shakeout, forced liquidations, big companies rethinking crypto treasuries, regulatory movement in unexpected places, and a market drop that left plenty of traders reeling. By the end of this video, you'll know exactly what triggered this week's crash and whether you should be worried or buying. Let's dig in. Story 1. Bitcoin dropped roughly 5% on December 1 and November closed out as a bloody month, down over 20% from earlier highs. That's not just volatility, this is a material unwind. Why? Traders were heavily leveraged, and when prices wavered, it triggered cascade selling. Bottom line, BTC moved from the mid-$80,000 range after early optimism, but the speed of the sell-off changed market structure. That sets the tone for everything else this week. Story 2. Liquidations. Over the week, hundreds of millions, if not more, in long positions were forcibly closed. Liquidations amplify crashes. One big margin call becomes several, and suddenly you're watching a domino line fall. Which means short-term traders were the biggest losers this week, and exchanges saw heavy order flow that pushed prices lower than they might have gone on spot selling alone. Story 3. Corporate treasuries. Some public companies that put Bitcoin on their balance sheets are now publicly admitting losses, and a few have even hinted they may need to sell to meet balance sheet needs. Big sellers, big impact. If a major corporate holder liquidates, it's not retail that supply the market has to absorb. That's one reason the market reaction this week felt worse than a typical correction. Story 4. Altcoins. Ether, Solana, and smaller tokens fell harder than Bitcoin in percentage terms, a classic risk-off move. Solana fell more than 7% on the day, and several meme coins were wiped out. If Bitcoin sneezes, altcoins catch pneumonia. Why? Many altcoins are still driven by spec flows and leverage. When BTC drops, speculative capital flees first from small caps. Story 5. Surprising regulation. Turkmenistan this week passed a law regulating crypto mining and exchanges, starting Jan 1, 2020. Regulation isn't always bad news, but it's a reminder that nations are moving on crypto policy, and those rules can shift mining economics or exchange access overnight. This is important because it shows new entrants, even resource-rich states, are formalizing crypto activity, which may change supply dynamics over time. Story 6. Macro. The biggest underlying cause this week was risk-off sentiment, rising bond yields, talk about tighter liquidity, and shaky equity markets. Crypto is less isolated than you think. When macro cracks, crypto often follows. So don't just look at on-chain data, watch Fed rhetoric, yield moves, and stock volatility. They're the strings that still pull this puppet. Now, what to watch next? 1. Institutional flow reversal. If companies stop selling and funds return, that stabilizes prices. 2. Liquidation levels. Further forced selling could push BTC into deeper correction. 3. Macro catalysts like central bank updates or major economic prints could move the market sharply. If you're trading, keep risk tight and watch liquidations. If you're a long-term investor, use this volatility to scale in slowly, only with money you can stomach to be locked up for the long haul. That's the week in crypto, fast, messy, and brutal for traders. Which of these stories surprised you most? Drop a comment, I read them. If you want a weekly breakdown like this, subscribe and hit the bell. Stay safe and see you next week.